So digging in the first, the U.S. economy. This first chart shows why we think it's going to be a slow return. These are recessions in the past, and you can see one of the worst recessions in modern time is the 2000-2009 pullback. But as you can see by this chart, that the drop in this most recent pullback far exceeds that extraordinary recession. So the Great Recession, not so great. This one exceeds it, and that orange line is the average recession. We're in a deep hole, and we've still got a lot of water to carry. And we have the ability to carry it and get out of this hole, but nonetheless, we still have work to do in terms of recovering the economy. The U.S. labor market, as we talked about earlier, it needs time to repair. And so this is U.S. unemployment numbers and labor participation rates. Again, what's extraordinary here is how fast the participation rate dropped, which means no one was in the market. Why? There was no jobs. Everything shut down. So we're seeing participation rate rise, and therefore that is the harbinger for better employment numbers in the future. I will go back. I will say what we said last year over and over again in our updates. Rate of change. How fast is the vaccine getting out? How fast is the economy recovering? How fast are we opening up the economy? That's what will help the jobs market. That's what will help the economy. To the point of the vaccines, obviously this is probably the most critical element in the economy and probably the highest risk factor. They have to work, and people have to take them so we get to full herd immunity. Obviously, the vaccines have come under scrutiny because of how fast they came to market. It's been somewhat of a political football. There's been all this question, should I take them, should I not take them? Our point on this is very simple. We said it in our coronavirus updates when we said we think the vaccines were going to come quicker than people thought. We have never seen in history the amount of money and the amount of focus from all the biological brain power go to one result, and that was finding a vaccine for coronavirus. It's unprecedented. We've never seen this much money devoted to one outcome. We've never seen the use of artificial intelligence to drive an outcome. So the fact that these vaccines came to market so fast is not actually terribly surprising if you look at that pure data, that set of data. Now, in terms of are they effective, we've never seen this kind of efficacy rates come out this early. So this is good news with the vaccine. What we need is acceptance. What we need is confidence. This next chart shows you some good news with regard to that. If we're going to get to herd immunity, at least 70% of people have to take this vaccine. Well, if we go to the numbers back in September, which admittedly was before we were getting all this data, and the survey asked, would you take the vaccine? Only 34% said definitely. Another 29% said probably. More importantly, definitely not was 20%. That's a big number. We don't have a big gap here to play with. In December, 41% said they definitely would, and another 30% probably were at 70% just on that survey, and that's December. So our hope is that as the vaccines come out and there's not big side effects and they're effective and cases start to drop and the vulnerable are protected, which is really the critical element here, getting the vaccine to the vulnerable and dropping this death rate significantly. Once that starts to build confidence, then we think these numbers go up. Our hope is by the summer everybody's vaccinated, and I think what we'll see is that this virus, while it is incredibly dangerous and it is incredibly pervasive in terms of its ability to spread, the reality is it can be killed. And then we have what we call the hat trick of policy support. So that's the Treasury, the Federal Reserve, and the U.S. government. So what do we see here? Well, the Treasury is putting money in the system. They're making it easy to borrow. They're backing up debt. The Federal Reserve, low rates, tons of money in the lending system. And then in terms of the U.S. government, we've seen multiple trillion-dollar plus stimulus packages. And that has had a very, very dramatic impact on the recovery here, and we think this is going to continue. I will say, this is our long-term warning here. You can't just keep doing this. You can't just keep pouring money in and expect no long-term result. Remember, I say this all the time, the U.S. government makes nothing, it sells nothing. The U.S. government is our tax dollars that go into the coffers and then get spent. So when we pour trillions of dollars into the system, we're borrowing from the future to get us through the moment. If we just keep funneling that money through, the hole gets bigger. The analogy I always use, it's like we're riding an aircraft carrier. We can't turn that thing fast. It's a slow turn. We see the rocks in front of us. The question is, are we going to start turning, or are we just going to speed up? And right now, we're just hitting the throttle and speeding up. It's something that has to moderate at some point. But all this money in the system has created this incredibly strong consumer, and really a consumer that's ready for a lot of pent-up demand to come rushing back into the economy. People are going to come back. They're going to buy clothes again. They're going to go back to their offices. They're going to need furniture. They're going to need washers and dryers and new automobiles and all of these different things that they've held off from buying over the last several months to a year. And so is the consumer in the position to have this demand pickup? As we look at these couple charts, go through these very quickly, personal savings rate exploded during the shutdown. Makes sense, right? Those people who were working didn't have anything to spend it on. Those who weren't were getting stimulus plus the 600. So people were actually getting what they were paid before or more, and they didn't have to go to work and they couldn't spend the money. So savings rates went up incredibly. Now they're moderated, but they're still high. They're higher than they were before the crisis. Debt service ratios are at record lows. We're not the same as we were in 2008, 2009, where the consumer was in the worst condition in the history. Now they're in the best in terms of debt. Consumer confidence is bouncing off the bottom and starting to come back. The vaccines are starting to show up in that consumer confidence number. And net worth of consumers are at a record high. Net worth. So that makes sense. If their debt's low, and the stock market's gone up, which means our 401ks have risen, and our house values have gone up because people are buying houses with low interest rates, that means our assets are up and our debt is down. That's very positive. The consumer is coiled up and in a good position to take off when jobs are back and some sense of normalcy comes back. That's the good news. Inventories need to be replenished. I don't know if you tried to get a part for an appliance or something like that. They're hard to get. Inventories at rock bottom. Companies don't want to make those kind of investments and take those kind of risks. So as we come out of this, and this chart shows we're at inventory levels back to where we were in the last financial crisis, those inventories, so not only are you getting the recovering sales from the pent-up consumer, but you have to build inventories beyond those points of demand. So this really is spring-loaded to make a very good recovery.